Hello everyone, my name is Deepak and I'm a tax code advisor. Today I'm going to be discussing some important data from Indian financial markets. If you guys are following the Indian market, you might have noticed that we are in a drop. Market have corrected over 10%, which is usually, for me, that's always a great opportunity. Anytime markets correct by 10, 15, 20%, I like to go and buy something. So for some of you guys who've been waiting for market correction, perhaps this is the time for you to look for something that you might like. But we should look at some microeconomics. We should talk about why this is happening. Why is the market in correction? Those things are important to understand as well. So I'll be sharing all the data that I have collected about the Indian markets right now. And obviously, US has something to do with it as well. So we'll talk a little bit about that. But before I continue, I want to remind everyone that I'm a tax code advisor. You come to me if you need tax advice, if you want to know how to save on your capital gains, how do you save on your W-2 income, how do you save on RSU sales. So if you want to talk about all that, I'm your guy. You give me a call. But I don't advise you on what to buy, what to sell, when to buy, when to sell. So for all of those kind of questions, you should always go to a local investment advisor. Those people have a lot more tools. They have a lot more specific information that I might not have. I'm just looking at very generic information. So please keep that in mind. But anything that you hear on the channel is not a tax, legal, or investment advice. Please do note that. Having that said, let's talk about what is happening in the Indian markets. Why are people spoofed off all of a sudden? Is it the Trump impact or something else? Well, first of all, let's get the facts right. So foreign institutional investors, we usually call these people the shark. These are the people who make or break the market. These sharks has taken out $34 billion out of assets and Indian markets in 2024. So just imagine that, $34 billion. In November alone, we saw almost $4 billion moved out of India. So that is a problem. In October, we saw almost 13 billion moved out of the markets. So the numbers are starting to kind of gain momentum, but hopefully December will be a lot better and market will start to stabilize. If we take a look at Nifty has dropped over 10%. It was at its highest back in September, and now it's on that roller coaster ride. So I think a lot of people are not happy with that. Now, what happens to India when dollars start moving out of the country? Very simple. Rupee start to lose, and we are seeing that. So rupee hit record low, obviously due to increased demand for foreign currency from these foreign institutional investors. Sensex and Nifty, on the other hand, only declined 6% in October. So this is telling us that the local market in India is way stronger than people anticipated. If you guys remember, about a year ago on a discussion call, we were talking about that, and somebody was saying that Indian markets are being really pumped up with a lot of funds from foreign institutional investors, which is true. A lot of money is going there, but Indian investors are still pretty heavy, because if the market was heavily dependent on foreign people, we would have seen good 20-30% correction in the Indian market. That did not happen. So are foreign investors going to continue to withdraw from India? I mean, obviously anything is possible, but I doubt it very much. The numbers have starting to slow down, so I think market is starting to stabilize. On the other hand, some of the big houses such as Goldman Sachs has already come out with prediction that in the next 3 months, Nifty will rise 3%. That means, these big guns are thinking that the worst is over and market will start to rise. So why are these foreign institutional investors selling out of Indian market to begin with? What's their problem? Well, number one problem, which we all know, is the US elections. Whenever elections happen, people get worried. They think that new administration going to do something funky, and Trump is like a wild card. Who knows what he's going to do? He has talked about 20% tariffs on all the foreign imports. So imagine if 20% tariffs were imposed, obviously that is going to impact a lot of businesses. So it makes sense that market will be a little bit spooked. On the other hand, India is also worried about inflation. So that is a problem. And even in the US, we are worried about inflation. We saw that last month we got that report that CPI is at 2.6, but that's not really true. In matter of fact, perhaps I should do another video as to why governments consistently report under inflation numbers. It's not by accident. There's a reason why they do that. And if you look at the your insurance costs, you look at your housing costs, you look at your food product costs, you look at the travel costs. Those of you guys maybe who has taken a airline trip recently will vouch for it, that inflation is quite higher than 2.6. I mean, we are making less money than what we were making a couple of years ago. So that's for sure. So there is that risk both in India and the United States. And then more importantly, if inflation persists, as a lot of people are thinking, and that's one of the reasons why we are seeing that interest rates for housing is not coming down. So if interest rates don't come down, and inflation continues to go up, and we have 10 or 20% tariff on foreign goods, what do you think the Indian stock market should behave like? I think it's behaving exactly the way it should behave. So these are obvious reasons. Then we also have Chinese factor. So those of you guys who follow the Chinese market, you might have noticed that China has flooded the market with a lot of stimulus, and people are making some good returns in China. So foreign direct investment in China rebounded after reaching 20 years lows back in 2021. So a lot of people were talking about how China game is over and it's the end of the story. But at the end of the day, it's money. Who can deliver the products cheaper? Who can offer better products at a better terms? And China is coming back and competing. So it's not going to be easy to compete with China. So that's another factor that's bothering the Indian stock market. And then the elephant in the room, just like in the US, is that Sensex and Nifty provided 20% yearly gains in 2023. That is overvaluation from, at least that's what a lot of people are talking about. And I think we can say that same thing about the US as well. I think as of today, our markets are up almost 25% in 1 year. So imagine somebody sitting on a $5 million or $10 million portfolio. Just in 1 year alone, they are making a lot of good money. Somebody is really, really happy with their retirement. 25% in 1 year is just simply not normal. The earnings growth in India has slowed to about 3.6% in Q3 of 2024. This is the slowest earning in the last 4.5 years. So no matter what people are telling you, oftentimes in the discussion calls we talk about this, that earnings are important. If the businesses are not making money, sooner or later market will come down. And that is exactly what's happening with India. Why? Because simply the cost factor in India has increased. Take a look at the labor, take a look at the real estate, take a look at transportation costs. Everything is up. So when everything is up, it takes away from those margins, and companies are simply not making enough money. And then our government, when I say our, I mean the Indian government, did not really help out a whole lot either. So if you guys remember, they increased the long-term capital gain from 10% to 12.5%. So that creates a lot of problem for investors as well. And then for foreign people, people like you and me who are more than likely watching this video right now, and we're thinking about investing in India in real estate or stock market, well, we have to pay attention to the dollar versus rupee. The Indian rupee, INR, has depreciated by 45% against the US dollar since 2014. So we are in 2024. Last 10 years, if you hadn't done anything, if you just left the money and all, guess what? You lost almost half of it altogether without doing anything. So that is very scary as well. So depreciation erodes the value of foreign investments, requiring these foreign institutional investors to achieve at least 16% annual return just to break even. So when and this, I'm talking about these big guys. These are their stated policies because they want to do at least as good as the US. So imagine if I was the institutional investor and I was investing in India, people will ask me, why are you going there? I mean, in the US stock market, you can earn 10, 12% very easily. Then why are you investing in India? Well, in order to give that answer, they need to make more money. And the 16% is the bare minimum number. If they don't make 16%, people are not happy. So let's talk about some of the trends that I'm seeing right now in the market. So like I said earlier, the 10% corrections, fairly healthy. So whenever 10% happens, a great opportunity for anybody to jump in and take advantage of that. Once again, I'm talking about markets in general. Individual stocks, different story. You need to really pay attention to what's going on with the company. But generally speaking, in the markets, if I get an opportunity to get in at a 10% correction, I would love that. 20% corrections does happen, but that indicates there's a bear market. So right now in India, Sensex and Nifty has dropped almost 11%. So, it still hasn't hit that 20% number, 10%. If I was an investor in India, I would probably start buying something and continue to buy it, at the lower price if possible. So, earnings is really a big issue. Sentiments in India is a big issue. US is a big issue. So all of those things are telling people that, hold on, save cash. Now, we all know Warren Buffett, right? Warren Buffett has been increasing the cash pile. He's telling us that, hey, markets, generally speaking, are overvalued. It is a good time to have some cash on the side. So that way, when markets drop, we can take advantage of that. I'm not a big fan of timing the market, by the way, so I'm not recommending anybody do that. I think over the long term, we'll be just fine. Matter of fact, Warren Buffett has talked about that many times himself, that don't worry about it, just invest for the long term, but forget about it. But again, we're Indians, right? A lot of people coming from India, they're always looking for these opportunities. Plus, it's kind of fun. It's kind of a lot of fun when you get something right. When things are wrong, when you make a mistake, it's very, very bad. But when markets are down, I mean, that's an easy win. Sooner or later that market will go up. It's just a matter of time, just waiting. So what I would say is, for the most of us, we should avoid timing the market and focus on long term. But if you are one of those who's looking for a thrill, then when markets are down, it's a great opportunity to buy it. I always recommend all people to always look into diversifications, avoid overexposure to some specific stocks. The more diversified you are, the better it is. Invest in reliable, low risk assets, for example, Nifty 50, especially during corrections. In a bull market, easy to get things right. Even if you make a little mistake, I think you'll be still doing okay in a bull market. But when we are in corrections, we need to be very, very careful, because if we make a wrong guess, if we pick a wrong company, that can go down a lot. So if I need to invest during corrections, buying into indexes is a great idea. If you have some stocks in India, maybe look for companies that has weak fundamentals, that you feel are overvalued, feel that are extremely sentiment driven. For example, there were a lot of companies in US when Trump was announced that he's going to win the election, they just skyrocketed, and they have really no fundamentals. So those companies just going to come back down. So look for companies that have strong moat. Look for current trends, what's going to happen. Always use dollar cost averaging. So those are simple things that you need to pay attention to. Let me cover some economic challenges as well, so that way that can give you some idea as to what's happening. So INR, the Indian rupee, depreciates anywhere between 4 to 5% annually. So that is a big problem, especially when people tell me that I want to buy an FD in India that is producing me 8%, 9%, 10%. They don't realize you have an inflation in India that is usually around 8%. And then you have depreciation of rupee, which is usually 4 to 5%. So that creates a problem. Now, the government said that inflation is about 6%, but I think most of you will probably agree that inflation is anywhere between 8 to 10%. So the point is, if I add inflation and if I add depreciation of rupee, I have to achieve 16% or better return in Indian stock market just to make sense that it's worthwhile. And I'm not even including taxes at this point. That's a whole different story, and FBOT and all kind of other issues that you have to deal with. Then in India, we also need to take a look at what is government doing. Same thing with the US as well. But take a look at the capital expenditure cycles. For example, how many roads companies India is building, how many bridges they're building, how many ports they have building. So when India start building, it puts more cash into the economy. That's usually good. So take a look at the capex for last several years. That will kind of give you a good idea as to what India is thinking about going forward. Okay, India's high interest rates are also a big problem. So many of us are used to that 2%, 3%, 4%. Even today, you can get a loan for about 6, 7%. That is not possible in India. So people don't realize that when a business needs capital in India, they have to spend a lot of money on interest, and that's why if any of you guys are from India watching this video, I always encourage people to set up a company in the United States, get an EIN number, start building your credit history in the US. That way you can borrow money at a lower interest rate. It just makes so much sense. I'm so surprised so many Indian companies don't take advantage of that one thing. Just running some revenue through your US EIN number can help you a whole lot, just from a credit point of view. Forget all the other benefits you get, but just from a credit point of view, I think this can be a big help. So if you have a friend, family member in India who's have a good business and you would like them to be able to take advantage of US system, encourage them to set up a consultation call with me, and I'll walk them through how setting up a company in US can be a big help for them. All right. So whenever you have a market correction, like right now, it offers you a chance to invest in the market. It offers you a chance to invest in undervalued stocks. So take advantage of that. Like I said, the foreign investors are moving out of India, but Indian institutional investors are stepping in. They are buying into the positions that have been left open by these foreign investors. So Indian market still seems to be pretty strong. A lot of Indians are also investing in Dubai. So you might have heard of that. So you might want to take a look at that as well. And obviously, if you're an NRI, you obviously have an option to invest in India. You have an option to invest in international as well as US. So you have a lot of different options to be able to diversify. Generally speaking, we advise people to stick with the US market. Why? It's just easier to manage. You don't have to deal with and honestly speaking, just the US markets, it's too much to keep track on unless you are a financial advisor or someone whose daily job is to keep track of markets. Is just kind of difficult. So that's why we advise people to just stick with the US. Focus on fundamentals. Look for companies that have strong financials. Look for companies that have competitive advantages. Try to avoid speculative bets. I hear that a lot. Like a lot of people pick companies that has weak moats, or they have unsustainable business models, or they are just marketing hype. Somebody went in there and they say, oh, we can do that, and they don't really have anything behind that. So be careful with that. Ensure that your investment in India is able to exceed inflation, depreciation, and taxes. Those are the three keywords I will leave with you today. Inflation, depreciation, and taxes. You need to be able to do those three calculations if you're thinking about doing anything in India at all. So those are some of the updates that I have for you from Indian stock markets, Indian financial markets right now. I would love to hear your thoughts, especially if you are from India and you're a financial advisor. Perhaps you can pitch in, put in the comments as to what's going on in India. I would love to hear more about that from you. And some of you guys who do invest in India, please do share your thoughts. Did I miss any point? What do you think is happening there? And it's end of the year, and at the end of the year we do something called year-end tax planning. So if you are running a company in the United States, whether you are in India or Dubai or in the US, and you want to figure out ways to reduce your taxes for 2024, this is the time to do consultation. Come December 15th, that will become extremely difficult. So please, if you want to set one up, go to taxcodeadvisors.com and set up a consultation call. Once again, my name is Deepak and I'm a Tax Code Advisors. Every few weeks we do a discussion call where we talk about all kind of micro trends. We take a look at the financial markets, the real estate markets, immigration, obviously the tax issues, and and debate it and discuss it. So that way we get a little bit more richer information. Like I said, even the information that I gather, personally speaking, comes from various different sources. I try to make it as comprehensive as possible. But again, it is possible that I miss a lot. That's why I do these discussion calls to kind of catch up. And then it helps me get corrected. Maybe I picked a wrong number. Maybe I said something that's not correct. And on discussion calls, people are welcome to correct me. So once again, the goal is that we can all learn together. Thank you so much for spending your last 20 minutes with me. And I'm looking forward to seeing you on the next discussion call. Thank you so much. Take care. Bye-bye.